Hugo, I'll never forget one of my first client meetings. The gentleman sat across the table and said, I don't trust shares or funds or any of these investment vehicles. Property is the only real investment. At least with property, you can't wake up tomorrow and your money is gone.
That's a common belief. You know what? He's not completely wrong. Property is tangible. You can see it, touch it, live in it, and for many South Africans, property equals to security.
But here's the twist. Today we have another way of investing into property, and that's REITs, real estate investment trusts. They're listed on the JSE. They own shopping centers, warehouses, hospitals, and even offices, and they give you a property exposure without the headaches of direct ownership.
So today, we're going to dive into a question we get all the time. Should I invest in direct property or REITs? And more importantly, how do these choices affect your retirement?
Welcome to the Family Wealth Retirement Masterclass. I'm Hardi, Swart, certified financial planner at Family Wealth Custodians. Over the past decade and a half, my team and I have helped many South Africans retire with confidence and clarity.
And I'm Hugo Kloppers, also a financial planner at Family Wealth Custodians. We are here to make complex retirement choices easier so families can act with clarity.
That's why we've created this masterclass to unpack big retirement decisions in plain English.
And if you care about making the most of your retirement, do us a favor. Hit like, subscribe, and join our retirement community. The link's in the description. We share weekly tips, articles, and insights. Let's begin with the big question. Why do South Africans place so much value on property?
I think the three main reasons are tangibility, it's physical. Unlike a share certificate, you can drive past it and say, that's my property. Secondly, rental income. The idea that your tenants pay off your bond have been passed down for generations. Third, we look at capital growth. If you buy a well-located property, say Stellenbosch, Constantia, or Umhlanga, and historically you've seen strong growth.
And let's be honest, Hardi, telling your mates you bought a rental flat gets a lot more nods than saying you bought into a REIT fund.
Exactly. Property carries status and it feels safe. But here's the part most people underestimate. Direct property has real challenges, especially in retirement. For instance, when it comes to liquidity, you can't sell your one bathroom or half a garage if you suddenly need cash. Furthermore, there's tenant risks, vacancies, late payers, or tenants damaging your unit. One bad tenant can wipe out a year's worth of income. Then costs, things like levies, rates, maintenance, special levies for sessional title, or agent fees, they all chip away at your yield. Then there's also concentration risk. 5 million rand in one flat is very different from 5 million rand spread across 115 companies or properties. And then finally, tax. Rental income is fully taxable at your marginal tax rate. And when you sell, you face capital gains tax.
And in retirement, the last thing you want is calls at midnight about burst geysers. I've seen too many retirees who thought property would be passive income, but it turned into a part-time job. So let's flip it. What exactly are REITs?
A REIT stands for Real Estate Investment Trust. Think of it like instead of you buying one flat or one shop, a REIT is a company that owns hundreds of properties, shopping malls, warehouses, offices, parks, hospitals, even storage units. When you buy into a REIT, you're buying a small piece of the entire property portfolio.
By law, REITs must pay out at least 75% of their taxable income as dividends to the shareholders, making them an attractive option for investors. Investing in REITs also offers a diversification benefit to investors as they behave differently to other traditional asset classes like equities, bonds, and cash.
For example, let's say Growthpoint, one of South Africa's biggest REITs. It collects R1 billion in rental income from all its malls and offices. At least 750 million rand of that must be paid out to investors. So if you own 100,000 rand worth of Growthpoint shares, you get your portion of that rental income every year without ever managing a single tenant.
And best of all, they're liquid. You can buy and sell them on the JSE in seconds, just like shares. No waiting 3 months for transfer, no lawyers, no deeds office, no fixing a burst geyser. Let's make this real with numbers. Suppose you have 2 million rand to invest. You can buy a flat in Cape Town for 2 million rand, rent it for 12,000 rand per month. After levies, let's say 3,000 rand, rates, 1,000 rand, insurance and maintenance, another 1,000 rand, you are down to 7,000 rand. Add tax at 30%, and your net income is closer to 5,000 rand per month. That is a 3% net yield.
Or, Hugo, you can invest that same 2 million rand in a REIT, yielding 7% per year. That's approximately 140,000 rand a year, or about 11,600 rand per month. No levies, no rates, no burst geysers, just dividends. And remember, the REIT owns a spread of properties. So if one tenant leaves, it's a drop in the ocean. While with a direct property, one vacancy means zero income until you find someone new. So let's compare two retirees, John and Sarah.
Okay, John, he puts away 6 million into 3 rental flats. He gets about 30,000 rand a month net after costs. But one flat is vacant for 3 months. Another needs a new roof. Suddenly, his income drops to 18,000 rand for the month, and he has stress.
On the other hand, we have Sarah. She puts approximately 6 million rand into a mix of REITs and balanced fund. She gets about 35,000 rand per month in dividends and withdrawals. And if she needs, she can sell 200,000 rand for medical expenses. She can do it in a week.
Both own property, but one owns it directly and the other indirectly. And her version is stress-free and liquid. But Hardi, we need to talk about tax because SARS always gets its bite.
Exactly. With direct property, the rental income that you collect is added to your normal salary or pension and taxed at your personal rate, which for some retirees can be as high as 45%. Then, when you eventually sell the property, SARS also charges you capital gains tax on the profit.
And with REITs, it's not a free ride either. The dividends you receive from a REIT are also taxed as normal income, not at a lower 20% dividend tax that you get on shares. And just like property, if you sell your REIT units for a profit, you'll pay capital gains tax. Let's summarize the big picture. A direct property is a tangible asset you can gear with a bond and potential pride of ownership, but it's illiquid, admin heavy, tenant risk, and high concentration. On the other hand, REITs. It's diversified, liquid, passive income, no admin headaches, but there's market volatility and dividend taxed as income.
And let's not forget, with a REIT, you can still invest, let's say, only 100,000 rand and own a piece of a massive mall or logistic hub. With direct property, you often need millions just to get started.
Hardi, so how do we use this in retirement planning?
Well, when it comes to direct property, it can work if you already have liquidity elsewhere, if you enjoy managing assets and are prepared for admin, and if you understand the risks of vacancies and costs.
REITs work if you want property exposure without the hassle, you value liquidity and diversification, you want a passive income at retirement.
And remember, it doesn't have to be all or nothing. You can own 1 or 2 rentals for diversification and use a REIT for liquidity and stability.
So here's the bottom line. Property can be a fantastic retirement asset, but how you invest in it makes all the difference. Direct property is like running a small business, while REITs are like owning a share of a professional property company.
We'd like to find out from you, so drop a comment below. Do you prefer the hands-on approach of direct property or the simplicity of REITs?
And don't forget to join our retirement community. The link is in the description. We share weekly tips, insights, and strategies to help South Africans retire smarter.
Thanks for watching. My name is Hardi Swart.
And my name is Hugo Kloppers.
This is the Family Wealth Retirement Masterclass. Keep investing into your future.